The crypto market will experience a massive drop as a result of the bear market, but what if we told you that you might profit from it? Watch the video ahead to find out how. Hello guys, welcome back to Crypto Point. In today's video, we'll tell you how you can make money in the bear market. But first, subscribe to our channel and hit the bell icon to never miss a video from us. That said, now let's begin. A bear market occurs when a market's price decreases for an extended period of time. It usually refers to a situation where stock values have fallen 20% or more from recent highs due to widespread pessimism and poor investor sentiment. Individual securities or commodities can be considered in a bear market if they experience a 20% or more decline over a sustained period of time, typically 2 months or more. Bear markets often are associated with declines in an overall market or index like the S&P 500, but independent securities or commodities can also be considered in a bear market if they experience a 20% or more decline over a sustained period of time, typically 2 months or more. Bear markets can also occur in conjunction with broader economic downturns such as a recession. Bear markets can be compared with bull markets that are heading upward. As time passes, the world's population continues to grow. Companies and their employees can also be more productive and create more products and services as a result of technology advancements. When demand for a product or service grows, so does its value, and so does the value of the firm that makes it. Stock prices are a reflection of the worth of the businesses they represent. While long-term patterns indicate that stock prices are growing, this doesn't rule out the possibility of market falls along the road. Stock prices decline for a variety of causes, including labor shortages, interest rate fluctuations, geopolitical disturbances, changes in consumer purchasing preferences, or a global shortage of a critical commodity such as oil. Stock prices are influenced by a variety of factors, including investor expectations and perceptions. Investors can sometimes make mistakes when estimating the worth of a company and how profitable it will be in the future. You've probably heard the term stock market bubble, which refers to when investors rush to buy stocks at prices that are higher than the firm's worth. Stock prices will plummet when this bubble breaks. Even when the markets are falling, some investors believe it's a good opportunity to begin investing. Increased spending, fewer layoffs, and other similar variables can help bring the market back to life following the decline, with the market increasing once more. When a bear market hits, it may be devastating. Any stock investor who was totally involved in equities during the years 1973 to 1975, 2000 to 2002, or 2008 can attest to this. To protect your eyes from the ugliness, you furiously pull your bottom lip up and over your forehead to lessen the pain from the devastation. Bear markets, on the other hand, are far shorter than bull markets, and if you're properly diversified, you should be able to ride them out relatively unscathed. Bear markets can present opportunities for savvy investors to expand their portfolios and create the framework for longer-term wealth accumulation. Here are 10 strategies for making bear markets bearable and lucrative. 1. Find good stocks to buy. Stocks of both positive and negative companies tend to fall in a bear market. However, weak stocks tend to stay down, whilst good stocks recover and resume to rise. The plan is obvious to the investor. When the stock of a good, profitable company falls in value, it's an excellent time to buy. Translation: there are a lot of good items on sale. Here's where a little basic investigation could turn up some gems in the rough. When you look for firms with strong sales and earnings, as well as a positive outlook, and then use some essential ratios, you can locate a wonderful stock for a low price thanks to that bear market. 2. Hunt for dividends. Stock price is determined by selling and buying in the stock market, whereas the dividend is determined by the company's net income. If the stock price falls as a result of selling, but the company remains robust, profitable, and pays a dividend, it provides a favorable purchasing opportunity for dividend investors. 3. Unearth gems with bond ratings. A bear market develops during difficult economic circumstances and indicates who has enough debt to deal with and who's managing their debt well. The bond rating becomes significant at this point. A company's bond rating is a frequently recognized assessment of its creditworthiness. An impartial bond rating agency such as Moody's or Standard & Poor's assigns the rating. The highest possible rating is AAA, which indicates that the agency feels the company has achieved the maximum degree of creditworthiness and is thus the least risky to invest in terms of buying its bonds. AAA, AA, and A ratings are regarded as investment grade, whereas lesser ratings such as B's and C's or worse imply weak creditworthiness. 4. Rotate your sectors. Adding exchange-traded funds to your stock portfolio can help you diversify and adopt a sector rotation strategy. Various industries perform well at different phases of the economic or business cycle's ebb and flow. When the economy is roaring and growing, companies that sell big-ticket items like cars, machines, high-tech, home remodeling, and other substantial purchases, as well as their stocks, do very well. These are referred to as cyclical stocks. Manufacturing and consumer discretionary are two sectors that reflect cyclical stocks. When the economy is growing and doing well, stocks of companies selling big-ticket items or wants do well. When the economy appears to be sputtering and heading for a recession, however, defensive stocks connected to human need, including food and beverage in the consumer staples category, utilities, and the like, are a good bet. 5. Go short in bad stocks. Bear markets can be challenging for good stocks, but they can be devastating for bad stocks. When bad stocks fall, they can continue to fall, providing the opportunity to benefit if they continue to fall. When a weak stock falls in value, it often falls even further when additional investors check into it and learn about the company's shaky finances. Many people would short the stock and benefit if it continued to fall in value. 6. Carefully use margin. Many investors don't use margin, yet it may be a strong weapon if used correctly. It can be a good strategy to use it to buy dividend-paying equities after they've corrected. Using borrowed funds from your stockbroker to purchase shares is known as a margin, also referred to as a margin loan. Bear in mind when you use margin, you're introducing a level of conjecture into the equation. Purchasing 100 shares of a dividend-paying stock with 100% of your own capital is a terrific way to invest, but doing it on margin increases the risk. 7. Buy a call option. A call option is a wager that the value of a specific asset, such as for a stock or an ETF, will grow in the near future. Buying call options is a kind of speculation rather than investment. Remember that a call option is a derivative with a limited shelf life. If you're not careful, it could expire and be worthless. The advantage of a call option is that it's relatively inexpensive to purchase and appears to be a very cheap vehicle at the stock market's bottom, bear market. This is where your skeptical side can shine. If a company's stock has been crushed, but it is in good form, strong sales, earnings, and so on, speculating on a stock comeback can be rewarding. 8. Write a covered call option. Writing a covered call entails selling a call option on a stock you already own. In other words, you agree to sell your shares to the buyer or holder of the call you wrote at a listed price if the value increases and meets or surpasses its strike price. In exchange, you'll be paid, referred to as the option premium, if the stock doesn't increase to the option's predetermined price throughout the option's life. An option has a finite shelf life and an expiration date. You can keep both the stock and the profit from the written call option. Writing covered call options is indeed a reasonable risk-free technique to increase the yield on your stock holding by up to 5, 7, or even 10%, depending on market conditions. Keep in mind, however, that writing a covered call has a disadvantage of requiring you to sell your stock at the option set price, referred to as the strike price, which means you'll miss out on any gains over that price. A covered call option, on the other hand, can be completely risk-free strategy if done correctly. 9. Write a put option to generate income. When you write a put option, you, the put writer, agree to buy 100 shares of stock or an ETF at a certain price for the duration of the option's life. If a stock you want to buy has just fallen in price and you want to acquire it, consider writing a put option on that very same stock instead. The put option pays you money, the premium, but it also binds you to buy the underlying stock at the agreed amount, called the strike price. But it's fine since you want to buy the stock at the option strike price anyhow, and you get compensated for it, the premium. Writing put options near the bottom of the bear market is a terrific method to make money. The only risk is that you may be forced to purchase a stock that you enjoy. Cool. 10. Be patient. A bear market shouldn't make you nervous if you want to retire in 10 years or more. Good stocks emerge from bear markets and are usually well prepared for the following bull market. So don't get out of stock so quickly. Simply keep an eye on the company's important figures, such as increasing sales and profits, and if everything appears to be in order, hang in there. Continue to get your dividend and retain the stock as it serpentine into the long-time horizon. Keep in mind, we aren't financial planners. You must undertake your own research and, if required, seek the guidance of a licensed financial advisor in order to make good financial decisions for your own requirements. And that's all for today's video. Don't forget to like this video and subscribe to our channel, CryptoPoint, for more such exciting content. See you in the next one.